Happy Thursday, everybody. Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. We have another big episode today. China's annual 2 sessions has now ended, and we officially have China's blueprint, economic and otherwise, for 2025. We need to discuss this, so let's jump in. China's leadership has set the GDP growth target for China in the year 2025 to 5% as anticipated. The weighted average of the provincial GDP growth target set in February came in at around 5.2%, which we covered at the time. That is why most analysts believe that this target was effectively decided months ago. Raymond Young, chief economist for Greater China at ANZ Banking Group, observed on the target, quote, "This number reflects authorities are determined to support growth against the backdrop of external uncertainties and trade tensions with the United States. It's an ambitious growth target, and it means the authorities will still need to support growth," end quote. In a tacit recognition of deflationary pressures, the government lowered its official target for consumer price increase to around 2%, the lowest since 2003. Trimming, it shows officials have conceded faster price growth will be a challenge after consumer inflation reached only 0.2% for the past 2 years. In his work report speech, Premier Li Qiang spoke on problems and challenges facing China. It is worth quoting what the Premier identified as these problems and challenges at length. Quote, "Internationally, an increasingly complex and severe external environment may exert a greater impact on China in areas such as trade, science, and technology. Global economic growth lacks steam. Unilateralism and protectionism are on the rise. A multilateral trading system is experiencing disruptions, and tariff barriers continue to increase. All this is undermining the stability of global industrial and supply chains and impeding flows in the international economy. The factors causing geopolitical tensions remain numerous, and they are affecting global market expectations and investment confidence and fueling the risk of volatility in global markets. Domestically, the foundation for China's sustained economic recovery and growth is not strong enough. Effective demand is weak, and consumption in particular is sluggish. Some enterprises face difficulties in production and operations, and overdue payments remain a prominent issue for enterprises." As an aside, these overdue payments that the Premier is referring to are from local governments to private enterprises. We continue with the Premier's quote. "There are pressures on job creation and income growth. In addition, there are weak links in our work to ensure public well-being, and some primary level governments have fiscal difficulties." End quote. That last line in particular is certainly putting it mildly. With all these issues then, why the confidence in 5% growth? Well, regular viewers will know exactly the answer to that, but to unpack it here, we turn once again to a regular voice on China Update, Professor of Finance Michael Pettis, who observed yesterday, quote, "Li Qiang noted that this would be an especially difficult year. In most countries, we would expect GDP to be higher when conditions are good and lower when they are bad. But his point was that whatever the conditions, China has already determined its economic growth rate. This shows how different the concept of GDP is in China than elsewhere, where GDP growth is the output measure, calculated at the end of a period after the economy has done what it has done. One way of understanding this is by considering that, to the extent the part of the economy that operates under hard budget constraints, i.e. cannot sustainably engage in non-productive spending, is unable to achieve the growth target, and it clearly cannot, an increasing amount of economic activity will shift to those parts of the economy that do not operate under hard budget constraints, which means that economic activity is increasingly transferred to government and to favoured sectors that receive unlimited funding from the banking system. This in turn means that a meaningful part of economic activity this year will again be in the form of non-productive investment funded by debt. And that is why, for all the recent talk of reviving the private sector, activity in the Chinese economy must continue to shift away from the private sector. This excludes favoured sectors, of course, whose ability to access cheap credit is implicitly or explicitly guaranteed by local governments or SOEs, who want to see production expand, even if it results in losses. And because non-productive investments by definition cannot generate sufficient growth to service the debt, we should expect to see another sharp rise in China's debt to GDP ratio this year. China's economy in 2025, in other words, will look a lot like its economy in 2024. End quote. Officials have already alluded to more fiscal support ahead too. Shin Danyang, the official in charge of drafting the government work report, published at the two sessions, said in a press briefing on Wednesday, quote, "There are in fact backup plans for macroeconomic policies, and policies will be adjusted dynamically to respond proactively to the changing situation." End quote. That is to say, we can pump the system up more if need be. Beijing identified its 10 major tasks for the year. We will quote some directly in translation. 1. Vigorously boosting consumption and investment returns and stimulating domestic demand across the board. 2. Developing new quality productive forces in light of local conditions and accelerating the development of modernized industrial systems. This is stuff like AI, EVs, chips, etc. 5. Expanding higher standing opening up and stabilizing foreign trade and investment. 6. Effectively preventing and diffusing risks in key areas and ensuring that no systemic risks arise. This is referring to the local fiscal and banking sector crises. 10. Working harder to ensure and improve the people's well-being and enhancing social governance. It's interesting to note that of the 10 priorities, enhancing the lives of regular people is listed 10th. Now, despite prioritizing consumption, listing this as the first of its 10 priorities, the policy announcements underwhelmed. Meanwhile, China's defense budget for 2025 is set to rise by 7.2%, maintaining last year's pace and outstripping the country's economic growth target of around 5%. The official military outlay will reach 1.78 trillion yuan, $245 billion, reaffirming China's position as the region's largest defense spender. Put this number in context, this quadruples Japan's defense outlay. Some analysts argue that the real defense spend is likely much higher as well. Premier Li Qiang emphasized the government's commitment to modernizing its armed forces, expressing yesterday, quote, "We will step up military training and combat readiness, speed up the development of new combat capabilities," end quote. He also reiterated the nation's strategic goals, pledging to, quote, "complete the tasks," end quote, "of modernization and enhance the military's technological capabilities." NPC, National People's Congress, spokesperson Lou Qinjian downplayed concerns about raising military expenditures, stating, quote, "peace needs to be safeguarded with strength," end quote. Peace through strength. Meanwhile, Stanford scholar Wu Guoguang noted that China's rapid expansion fuels international unease, adding that the quote, "China threat," end quote, stems from the country's opaque governance structure. The comments that China's military and top leadership have made in relation to the East and South China Seas, as well as the relationship with Taiwan, likely also doesn't help. So, with all these announcements, how is this all being paid for? Well, Beijing also announced yesterday that China is targeting a fiscal deficit of 4% for 2025. Well above the 3% target in 2024 and the highest fiscal deficit since 1994. Indeed, it's even higher than during the COVID years. China has for decades tried to keep the official deficit at no more than 3% of GDP. This was always thought to be a red line for Beijing policymakers to demonstrate fiscal discipline. Crossing that implicit red line signals General Secretary Xi Jinping's willingness to take unconventional steps to boost domestic demand, or at least to stimulate the economy, as a trade war with US President Donald Trump threatens exports, which make up nearly a third of the country's expansion last year, and as the property sector still suffers from a years-long slump. Local debt risks are also forcing the central government to take on more borrowing responsibility from regional authorities. Out of the total government bond quotas set for this year, 56% will be shouldered by the central government, up from 48% last year. Incredibly, according to calculations by US outlet Bloomberg based on official figures released this week, the broad deficit rose to a record 9.9% of GDP. This measure refers to the gap between revenue and spending combined under China's general public budget and the government-managed fund budget. Where is Beijing getting this extra money from? The work report lays this out. 1.3 trillion yuan of ultra-long special sovereign bonds, up from 1 trillion last year, 500 billion yuan of special sovereign debt to recapitalize state banks, 4.4 trillion yuan of special local notes for Chinese provinces, higher than 2024's 3.9 trillion yuan, a total bond quota of 11.86 trillion yuan, 2.9 trillion yuan higher than a year ago. On this point of the fiscal deficit, we return to a separate observation made by Professor Pettis today. Quote, China in fact has been running huge fiscal deficits for over 2 decades, but these mostly occurred at the provincial and municipal levels. As their borrowing abilities have been tapped out, it is no surprise that some of this has to be transferred to Beijing, that is the central government. The important point is that as long as Beijing sets GDP growth targets that exceed the growth that can be obtained by those parts of the economy constrained by hard budgets, the point that he made earlier in this episode, the debt burden has to grow. In an economy with extensive capital controls and a banking system that operates under window guidance and whose credit is underpinned by moral hazard, it is the growth in debt that matters, and much less so on whose balance sheet that growth occurs. End quote. China's total debt continues to rise rapidly. Outstanding total debt surpassed 400 trillion yuan, $55 trillion in September of last year, equal to 310% of China's GDP, up from 300% at the end of 2023. By January, total debt was increasing at a rate of $1 trillion a month, much faster than debt growth anywhere in the world, including the United States. Hey guys, I hope you're enjoying today's episode of China Update. If you're getting some value, I have a huge favor to ask. That is just to hit that like button. It is a click of the mouse, but it's a big help for me and the algorithm. Also, and this is very interesting, 45% of regular viewers, these are viewers that watch most episodes, are not subscribed. It is also a tremendous help for the algorithm, and it is, again, a click of the mouse if you hit subscribe and the bell notification. That way you'll be on top of the most up-to-date analysis on China as it's released, and it's a big help for the channel. Patreon and Buy Me a Coffee links are also in the description for those who want to help keep the channel financially sustainable. I rely primarily on subscriber support. It is just me making these, filming these in my bedroom or my office 6 days a week, so this help is also much appreciated. Thank you so much. Now, the first half of today's video was quite heavy, so let's move to something a bit more light, though important to note. Shares of China's largest bubble tea chain, Mixue, literally honey snow, soared more than 40% on its debut in the Hong Kong Stock Exchange on Monday, marking a triumphant entry into the public market. The stock closed at $37, up 43% from its IPO price, giving the company a market valuation of $14.2 billion. This historic IPO, raising $450 million, is the largest in Hong Kong's food and beverage industry, further solidifying Mixue's dominance in the global bubble tea market. Investor enthusiasm for Mixue was unprecedented, with the Hong Kong offering oversubscribed more than 5,200 times, while the international portion saw over 35 times the expected demand. Originally, only 10% of the IPO shares were allocated to the Hong Kong offering, but due to overwhelming interest, Mixue increased the share to 50%, balancing it with the international offering. Founded in 1997 by Zhang Hongchao in Henan province, Mixue started as a humble shaved ice shop. Over the past 2 decades, the company has aggressively expanded, culminating in its current status as the world's largest food and beverage chain by store count, surpassing McDonald's and Starbucks. As of December 2023, Mixue operated 46,479 stores across 11 countries, including China, Southeast Asia, and Australia. Now, many have claimed online that Mixue has dethroned or surpassed McDonald's. While this may be the case in terms of the number of stores, in terms of market cap, the Chinese food and beverage chain's $14.2 billion is dwarfed by the $220 billion market cap of McDonald's. Starbucks, meanwhile, is also much bigger at $130 billion. Mixue's success is attributed to its affordability and franchise model, selling ice cream and bubble tea for as little as 6 yuan, 83 US cents. The company caters to cost-conscious consumers, particularly in China's Tier 2 and Tier 3 cities. Unlike its premium competitors, Naoki and Haiti, which dominate first-tier cities like Beijing, Shanghai, and Guangzhou, Mixue has built its empire by targeting smaller markets with lower overhead costs. But how does the product taste? Well, there is only one way to find out. Okay, so this is a first. Since we're talking about this new company this week and its IPO in Hong Kong, I thought I'd take the opportunity to actually try it because these places are everywhere across China. I see them all the time, but I've never really been in because I'm not a big fan of bubble tea or soft serve ice cream. So I've just wandered past one. I'm going to pop in, look at the prices, try a couple of the products, and I'll let you know what I think. Okay, so these are the two that I got. This is like a soft serve sundae. I think they've got some strawberry at the bottom and Oreos on top, and then like a chocolate dip on top. This was, I think, this was 9 RMB, so this is a little bit over $1 US. This one here is sort of a more traditional bubble milk tea. Okay, so we're going to start with the sundae first. It definitely tastes like it's $1. It's quite a sickly sweet soft serve. Cheap chocolate on top, but it's okay. I mean, for its price, if you were going to eat something like this, it is a very good price. For me though, it's just a little bit too, it tastes quite sickly sweet. Now I'm going to try the bubble milk tea. It's quite big. This is about $1.20 US. So also a pretty good price. It's actually a little bit better than the sundae. This is basically what you would expect in China for a basic bubble milk tea. For me, it's a little bit too sweet, but $1. I can see why a lot of folks, especially low-income folks, would select something like this during a period of economic downturn if they wanted this sort of treat. But for me, not quite my taste. Now back to the studio. With its IPO proceeds, Mixue plans to expand its global footprint further. Approximately 2/3 of the funds will be directed towards international expansion, with eyes on, among others, the US market, while 12% will go into brand building and intellectual property development. Another 12% is set to enhance Mixue's digital and smart capabilities, with the remaining funds allocated for general business operations. Industry analysts see Mixue's rapid growth as a sign of strong investor confidence in the bubble tea market. Some experts predict that Mixue will follow in the footsteps of competitors like Haiti and expand into Europe and North America, although no official plans have been announced. Despite its dominance, Mixue faces challenges, particularly in entering China's premier-tier cities where established brands like Haiti and Naoki have a firm grip. Additionally, as the company continues expanding, there is a risk of market saturation and internal competition among its franchisees. Whether it can sustain its rapid growth and expand further into Western markets remains to be seen. But for now, Mixue has cemented itself as a global powerhouse in the bubble tea industry. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a good Thursday, and I will see you all tomorrow.